Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Friday, May 29th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Today we were up 48 basis points on the S&P 500 and closed at 3044.31. The first chart that we're looking at is an intraday chart of the S&P 500, so it's a one-day chart where each candlestick represents 1 minute of trading. And as we can see here, we gapped down at the open. Of course, the dotted blue line is where we finished up yesterday. So we gapped down at the open, went positive just after 9:45 for just a couple of minutes, and then during the middle of the day actually went below 3,000 for less than 1 minute. And as we can see here, kind of traded sideways with some volatility through most of the afternoon. And then right after President Trump started to speak on his conference call, the market obviously liked what it heard and took us from negative for the day to positive. And as we can see here, we closed near the highs of the session, again closing at 3044.31, up 48 basis points for the day. The next chart that we're going to look at is a 6-month weekly chart of the S&P 500, so each candlestick represents 1 week of trading. The importance of this chart is to show that on a weekly basis, this is the first time we've been able to close above the 40-week moving average, this blue line here, since this whole downturn started back in February. And of course, this means that we're also now closing above the 200-day moving average. So this is a year-to-date chart of the S&P 500. The orange line is the 200-day. And we can see here that we now have 3 days where we've been able to close above the 200-day moving average. The next chart that we're going to look at is a 12-year weekly chart of the S&P 500. So each candlestick represents 1 week of trading. And the blue line again is the 40-week moving average. What I wanted to do is point out over the last dozen years, these times that we've spent time below the 40-week or 200-day, right, same thing, moving average. So what I thought we would do is go back and look on daily charts. We're going to go back and look at each one of these times where we've been below the 200-day moving average, and then coming out of that, right, once we start to get above the 200-day moving average, what does the market act like? So this is going to be really interesting. This chart is a chart of 2008 and 2009. Of course, it's a daily chart, so each candlestick now represents 1 day of trading. The orange line is the 200-day moving average. And as we can see here, in 2008, we came up and kissed the 200-day moving average, couldn't get above it, and then finally got above the 200-day moving average back in the end of May, beginning of June of 2009. But you can see here that we kind of climbed it down, right? The 200-day moving average was in a downward trajectory still after the multi-year downturn that we experienced starting in 2007 and then, as we know, ending in 2009. Even though we were above the 200-day moving average, you can clearly see that we were walking down the 200 for over a month there before we finally snapped out of that behavior and took off and started to climb out of that. So that was very, very interesting. The next time period we're going to look at is 2010 and 2011. So 2010 is on the left side of the chart, 2011 is on the right side of the chart. You can see here in 2010 that the market fell beneath the 200-day moving average and had several attempts where we got above the 200 for just a few days and failed, got above it and failed, and then finally in September we were able to get above the 200-day moving average for a while, and then going into 2011, first part of August of 2011, and we fell beneath the 200-day moving average, got above it, beneath it, above it, and we had, again, multiple attempts in the latter part of 2011 to get above and stay above the 200-day moving average, but we kept failing at that attempt. So I hope you're seeing here that just because we've got above the 200-day moving average a couple of things here. It doesn't mean we're going to stay above it, and it doesn't mean it's going to be clear sailing. It might be, right? We might be able to do this, but it's not unusual at all for us to stall or even fail at the 200-day moving average. And you can see this over multiple time frames where we've been beneath the 200-day moving average and then try to get above it, and then we fail and fail and fail. Next, we're going to move forward by 1 year. So this is 2011 here, and this is 2012 over here. So again, we just looked at 2011, but now I just want to pull it forward 1 year, because coming out of 2011, we can see here that once we finally pulled out of this right at the end of 2011, beginning of 2012, we climbed above the 200 for a while and then revisited the 200-day moving average and basically pulled back to the top of this range. So from here to here, you can see we made virtually no progress. Just because we're at the 200 doesn't mean we're going to be able to stay above it, and it doesn't mean it's going to be clear sailing from here. It might be, but in most cases, as we're seeing here, by examining the evidence, by examining the markets, what does the S&P 500 normally look like? How does it behave once we've spent time below the 200-day moving average? Once we get back above it, what does it look like? How does it act? That's what we're looking at here. And as you can see, in multiple time frames, it's generally not clear sailing from there. Even if we get a couple of good months, it's not uncommon for us to pull back to at least the 200-day moving average over the next few months. Okay, and again, we can see the attempt here, and again, we pull back to the 200-day moving average. We made a little bit of progress from here to here, but we keep pulling back to or just below the 200-day moving average. The next time frame that we're going to look at is July of 2015 through June of 2016. And as we can see here, we fell beneath the 200-day moving average in August of 2015. And then we got back above it, couldn't hold it, got back above it, couldn't hold it, got back above it, couldn't hold it. And going into 2016, spent a few months beneath the 200-day moving average and finally got back above it in March of 2016, only to pull back to this level again in June of 2016. So you can see that oftentimes, once you've spent some time beneath the 200-day moving average, it can be kind of rough for a while before you really get some traction. The next chart that we're going to look at is from July of 2018 through June of 2019. So this captures the downturn that we saw in Q4 of 2018 and that quick V that we made, and then we jumped back above the 200-day moving average in February of 2019. But as you can see here, once we fell beneath the 200-day moving average in Q4 of 18, we kept going up and down, crossing over the 200-day moving average, but we couldn't successfully hold it. And then we had that quick V bottom, and then we jumped back above the 200-day moving average. And then as you can see here, we had a few weeks where we were above it, pulled back to the 200-day moving average, had a few months above it, pulled back to the 200-day moving average. So again, making really very little progress for many, many months once we broke above the 200-day moving average. So I hope you're seeing here that it's pretty common once you've spent some time below the 200-day moving average and get back above it, it's very common to kind of go sideways with some volatility for many months after you regain the 200-day moving average. So only time will tell if that's what we're facing, but now that we're back above the 200-day moving average, just understand that it does not mean that it's going to be clear sailing from here. It may be, but the evidence shows by looking at the last dozen years and looking at the times when we've spent time below the 200-day moving average, as you can see, more often than not, it's kind of a tough slog for weeks, if not months, beyond when you finally cross back above the 200-day moving average. Now what we're looking at is a chart of 2018, and I have this annotated with the Simple Market Signals signals. So these are the weekly signals that come out and are published in the newsletter. And so what we can see here is the signals, the Simple Market signals are green, yellow, and red. So I'm just going to go through this very quickly. We're going to take a look at a couple of charts, but I want you to understand how these signals work and how they can help you. So first off, we have the green signal, and the green signal is the best risk-reward signal for equity investors. And what you're going to see here is that most all upward progress in the stock market is going to be made when the signal is green. And then we have the yellow signal. Now, the yellow signal indicates change, and generally what happens is after a green signal environment, then the signal will change to yellow, and if the sell-off gets bad enough, it'll change to red. Now, in this time frame here, we had both yellow and red signals. I just kind of clumped those together just to kind of give you an indication of what happens. It's very, very hard to make money in the stock market when the signal is either yellow or red, okay? So again, most all of your upward progress in the stock market is going to happen in the green signal environments. During a yellow signal, you're either going to be sideways to slightly down is kind of the realistic expectations, but oftentimes that yellow signal will be that transition signal between a green signal environment and a red signal environment. So in 2018, we went green, we were green here, and then the signal went yellow here, and then it turned red, and we'll take a look at that here in just a second. The red signal is your worst risk-reward signal for equity investors. And your worst downturns, including bear markets, happen during a red signal. And we'll take a look at this here in just a second. Now, let's focus on this time frame right here where the signal went yellow. And we're going to switch to a chart that's going to straddle from September of 2018 through March of 2019, because I want you to understand what happened here. So right here, we had this green period, and then the signal went yellow here. And so what we're going to do is go over here. So right here is where that signal went yellow, all right? And then a few days later, the signal went red right here, and that was in October of 2018, as you can see down here. And then we had some sideways choppy movement, and then a quick sell-off. We bottomed right here in the latter part of December, and then the market started to rally. Now, a couple of things to understand is the market will bottom during the red signal, okay? Because again, remember that simple market signals, the weekly signals, measure risk levels in the stock market. So green is your best risk-reward ratio for equity investors. Red is the worst risk-reward signal for equity investors. And a yellow signal indicates that there's change, that risk is rising, and sometimes that risk gets bad enough that that signal goes red, okay? But anyway, so we bottomed here. The market started to go up, and we can see here that the signal went back to green right here. During shorter red periods, oftentimes the red signal and the green signal come out at about the same price level, okay? And I'll show you here on another chart in just a minute that the longer the sell-off, the lower that green signal is relative to where the red signal came out, and that'll make sense here in just a second. But again, this is just based on market metrics and market internals and things that go into the model, and it's about risk levels, okay? So if you get one of these quick sell-offs that rebounds very quickly, your red signal and your green signal can be in a very similar place, okay? So just understand that simple market signals measures risk in the stock market, and as you can see here, these rally attempts, right, because this was red, right, we went red here, so you get these rally attempts that fail, and then it sells off hard, rebounds pretty quickly, and then the signal goes green here, all right? Now, we're going to pick up right here, so this, again, is that transition period right here, all right? So now we're going into 2019. This is calendar year 2019 in the S&P 500, again, daily charts. So this is that red period. The signal went green here. So you can see here when the market is green, this is the best risk-reward ratio for equity investors. And during the green periods, this is where most of your upward progress in the stock market is made. Let's move back and go back to 2007 through 2009, and now we're looking at weekly candles. And what I want you to understand is when the market goes into a prolonged bear market, what really happens here, okay? So now we're going back again. This is 2007. The signal, the weekly signal, when I back tested this, because remember, the model came together in 2017. I worked on this for 20 plus years to figure this out. Finally, all the components came together in 2017. So what we were looking at here, okay, what we're looking at here is actual data. These were the actual signals that the model generated in 2018 and going through 2018 to 2019 transition as we looked here, and then 2019. So this, however, is back testing. So the original red signal that came out during the bear market that started in 07 and ended at the beginning of 09 came out right here, all right? Again, around 1,500 on the S&P 500. And as you can see, we, sold off for a few months. We had this rally attempt that failed and then sold off hard again, bottomed, and the market started to rise, and the signal came out green here. All right. So this is what happens during longer sell-offs, during longer red periods. Your red signal and your green signal have a huge price differential. Just between here and here, the market was down about 40%. Now, if you lose 40%, guys, it takes 66% to get back to break even. All right, so just to get back to 1,500 after if you've got 875 left and you're trying to get back to 1,500, that is over a 66% gain that's going to be necessary to bring you back up to break even. All right, so this is where simple market signals can really, really help during all market phases. But if it can help you minimize your losses during downturns, regardless of whether it's a multi-year downturn that ends up being a super long bear market or a shorter downturn like this, if you can use the signals to help minimize your losses and maximize your gains, right, during the green periods, that is where this thing is really going to help you, okay? So the whole key here, and this is where most people get it wrong, is start with the stock market first. What is the overall market environment like? Whether you're trading the S&P 500 through, SPY or a mutual fund or whatever it is, or you're working in the Dow, or you're working in the triple Qs, or you're trading individual stocks or options, you need to get the stock market right first. What is the environment you're working in? Okay, are you in a green environment? Are you in a yellow environment? Are you in a red environment? Get the market environment right first, and then everything else becomes so much easier after that. Thank you for watching this video. Before you leave, don't forget to subscribe to this channel. Please give me a thumbs up on this video and check out some of my other videos. I have a lot of great educational videos on this channel. And if you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, 403b, your IRAs, or of course your trading account, I would encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about how Simple Market Signals can help you in both up and down markets, here's some additional information. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signal subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.